Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness Podcast. I'm here with my co-host Walter Dial, who is tax partner at GRF CPAs and Advisors here in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value and for planning your eventual exit from the business. We want to help you build a business that is sellable and then exit successfully on your own terms and conditions. Our guest today works with Walter in the tax and exit planning departments of GRF CPAs and Advisors, Steve Boisvert. Hey guys, how's it going?
Good.
Things good in Florida there, Steve?
Things are good. It's 60 and going up to the mid 70s this weekend.
Very nice. It's 20 degrees right here as we speak. Okay, so guys, one of the themes here on the podcast, Steve, is Walter and I like to provide ideas and information that can help an owner protect as well as build the sellable value of their business, protect the value of their business. And so one of the key areas for protecting value, of course, is your core business, you and Walter, in tax planning. And a key driver of tax planning for a small business is how their business is structured or what entity they choose to be. Should they be an LLC, an S-Corp, C-Corp? Then should they have one structure as they launch and grow and build versus another or a different one when they leave and exit? So, what is typically the best structure in these situations from a tax perspective? That's our topic today, protect business value with the right business structure. And so, Walter, let's start with you. Let's begin. Just give a general explanation, Walter, of why the type of entity chosen by an owner is important. And then once you've answered that question, review the choices available to a business owner.
Okay, sure. So, when you ask about why is it important, why is the entity important, I guess three things come to mind. One is the type of entity that you select is going to determine the tax ramifications. Meaning, is the business going to pay tax, or are you going to file a return that's going to report income on which you pay tax, or is everything just going to go right on your individual return? So the first consideration for entity choice is tax. Second is choice of entity can determine who can actually be owners of the business. So for instance, if you decide to be an S corporation, there's limits on who can own the business. And I'll talk about that as we go into S corps. And then finally, your choice of entity determines how you can take money out of the business. So we'll talk about that in a little more detail also, but depending on the type of entity, you may have to take a salary. Other entities, you can just take distributions whenever you want. So those to me are really the three main points in choosing your type of entity: the tax effect, who can own it, and how you're going to be able to take money out of it. And then the second part of your question, when it comes to what choices are available to business owners, let's start with the most basic, which is just a sole proprietor. And that tends to be a very small business, probably not a lot of incentive to grow the business. And the beauty of a sole proprietor is it's just very simple. You just fill out a Schedule C on your individual tax return. You report the income and expenses, and you pay tax on the net profit. It just simplifies things a lot. And we tend to see this mostly where someone has kind of a quote unquote hobby type business. Maybe they have a full-time job, but they got something else going on the side. There's no liability issues associated with it or anything. They're just, collecting some revenue and have a few expenses. That's a perfect setup for a sole proprietor. The next level up is going to be a single member limited liability company or single member LLC. And from a taxation standpoint, a single member LLC is just like a sole proprietor. You put all the information directly on your personal return and you pay taxes on the net profit. What you've gained by becoming a single member LLC, and is the fact that you are now afforded some level of liability protection, and you also gain the benefit of, you appear to be more like a real business, because now instead of just saying, "Hey, I'm Walter Dial," I can say I'm, Accounting Services LLC or something. So that's the next level, single member LLC. Then you get to the next level, which would be a partnership, or nowadays it's usually a multi-member limited liability company. So limited liability companies have kind of taken over for partnerships, and they are far and away the most popular business entity out there right now, is the limited liability company with multi-members. And now you're to the point where you're filing a separate tax return for the entity. They file a Form 1065, but LLCs are what's known as a flow-through entity, meaning even though they file their own tax return, they don't pay tax. Instead, they file a tax return that reports all the income and expenses from the business, and then they flow that income out to the owners of the business. And then the owners pay tax on their own individual tax return. So from a taxation standpoint, it's just like a sole proprietor or single member LLC. It's just that you have this separate return that reports all the details, and then your personal return is just reporting the profit or loss number. Then you can get into the slightly more complicated entities. So the next flow-through entity is an S-corporation. So when I mentioned that choice of entity can determine who can own it, this is where the S-Corp has limitations that other entities do not. So for an S-Corp, number one, it can only have 75 owners, which for most of our clients is not a big deal. But it cannot be owned by a corporation. It can't be owned by a partnership. It can't be owned by a non-resident alien, and only certain type of trusts can be S-Corp shareholders. So you can run into issues with who owns your S-Corp. So that's something certainly to be aware of, because you could have an ineligible shareholder and may not even be aware of it. So you got to make sure, if you have like an individual, you got to make sure that they're not a non-resident alien, and if you have a trust, you have to make sure it's a qualified S corporation trust. But having said all that, assuming that your owners are fine, again, the S corp, similar to the LLC, is going to file a separate tax return. It's going to file an 1120-S. It's going to report all its income and expenses, and then it's going to issue K-1s, just like the LLC does, and each shareholder is going to report their share of the income or loss of the S corporation. And then your final type of entity is a C-Corp, and that's IBM and Apple and Facebook and Amazon and all those. So a C corporation, it's going to file its own return, but unlike the other entities, it is not a flow-through business. So it actually pays tax on its profits. So it files separately, and it's a totally separate tax-paying entity. We tend not to see a whole lot of C corporations because, as you can kind of imagine, if it's paying tax, then it's going to flow money out to the owner, who then is going to pay tax again. So there's a potential for double tax with C corporations. So you generally don't see them in smaller businesses, although there are certain circumstances where it can make sense, and we can talk about that. But that's just kind of an overview of why the type of entity is important and the choices that are available to a business owner.
Yeah. Okay. So thanks, Walter. Steve, what do you typically recommend to an entrepreneur who's launching a new business? And, particularly speak to situations when you might recommend a C-Corp for an entrepreneur who's launching.
Yeah. I mean, what we would typically do, our default, in a sense, is the LLC. But as Walter was mentioning, if there's really no potential liability issues in the businesses, the owner's not really looking to grow the business, maybe it's just a small consulting practice, and sole proprietorship is fine. But as I said, the default for us is typically LLC, just because it's so flexible. There's so much agility there that you can do with an LLC. You can become an LLC and file a Form 8832 to decide hey, I'm an LLC, but I want to be taxed as a C-Corp or as an S-Corporation, or maybe you're a multi-member LLC. The default's going to be a partnership. Or you can choose, again, S-Corp or C-Corp. But for, a very small business, the LLC really does offer the liability protection you're looking for. And, business owners will often say, okay, I want to set up an LLC. Do I just do that on LegalZoom? But I try and steer my new clients away from LegalZoom. There's just a lot of traps for the unwary, especially when you're setting up a business entity. I always try and refer them to a good lawyer who can set up a good agreement, liability, or LLC agreement. But if you're looking to grow the business, the LLC does give you that kind of real business appearance. You can start out as an LLC, file a Form 8832, choose to be taxed as an LLC or as an S-Corp or as a C-Corp, however you prefer to be taxed. The single member LLC does give you that flexibility with your personal tax filing. That's the easiest way to do it. You can just file a Schedule C. But there are tax reasons why you may want to become an S-Corp, or there are tax reasons why you may want to be taxed as a C-Corp.
So, hey, can I interject right there?
Yeah.
One of the questions we often run into is LLCs who at some point start to question whether or not it's the right move to shift to an S-Corp. How would you answer that question?
Yeah. So it really becomes, normally when we have clients ask about the S-Corp, they're normally interested in the ability to work with the self-employment tax issues. And you really get into discussions then on what's a reasonable salary for my client. The client has to kind of do some of their own work trying to figure out what is the industry standard for a reasonable salary. And the reason it matters is because you're only taxed, your dividends from an S corporation are not going to be taxed on the self-employment tax portion. So, there's a tax benefit there. I don't know, Walter, if you want to get into that a little bit, how the S Corp can really provide you that self-employment benefit. I know that was for a long time your entity of choice for some of your clients.
Yeah, it's probably a little bit beyond the scope of what we're doing here. It's a really good point, though. And what I would kind of say is you're 100% right that there is the potential to reduce your payroll taxes, which can be substantial depending on the size of the business. If you go from LLC to S Corp, I think for a lot of our clients, like you said, the default is pretty much LLC, just because it's a very flexible way to do business. It doesn't require the owner to take a salary. They can take money out of the LLC, however they want, like whenever they need it, or they could set themselves up on a little distribution schedule supplemented by bonuses or something. So it's very flexible on the distribution side. And then, once you're looking at maybe a couple $100,000 of profit, then it may make sense to switch to an S Corp, because at that point, you may be able to take a salary and distributions. Under 150 or so, pretty much everything you take out is going to be considered compensation. So there's really no point in going through the S Corp. Because keep in mind, once you're an S Corp, you've got the separate filing, so you've increased your expenses a little bit, and you have to do payroll, which it might not seem like it's a pain, but it really is, especially if they try to do it themselves. I mean, once you run afoul of the requirements, you're kind of on the IRS mailing list for the rest of your life. So, that's my big consideration, is you really need to be able to take on some more administration before you switch to the S Corp to make it worthwhile.
And there may be other reasons for doing it. Maybe your Schedule C is pretty intensive. Sometimes that can be an audit risk from the IRS. And so you may make an S election just to, I guess S corporations are less likely to be audited than a C Corp.
That's a good point. Yeah, that's a very good point.
There's that consideration. Then Walter brings up the issue of flexibility within an S-Corp. It's not a very flexible format. It's been around since the 1930s, so there's a lot of case law on it, which is a good thing. But when it comes down to, being able to allocate your income, allocate your expenses, the LLC is so much more flexible. Just if we were to do a simple example, say you've got an S-Corp that has two shareholders, both own 50-50. If you have $200,000 in net income, each shareholder is going to take $100,000, but maybe one shareholder is really working the business and the other guy's just sitting on the beach. And the guy that's sitting on the beach says, I'd like to take out $100,000 from this business. And the guy that's working the business really hard says, I'd like to leave the money in. Well, you can't have disproportionate distributions within an S corporation. An LLC, you can distribute however you want to. You can allocate the income however you want to, as long as there's economic effect within the LLC. So there's just a lot more flexibility within the LLC that, so there's all those considerations you have to really take into account when your client says, hey, well, what about S status? It may make a lot of sense, from the payroll tax perspective. But if you're looking to add a partner down the road or multiple partners, the flexibility of the LLC is really where you want to be.
Yeah. Hey, Steve, you mentioned something very interesting as I'm going to go, that you're more likely to be audited with a C-Corp than an S-Corp.
Not a C-Corp.
Is that right?
Not a C-Corp. So Schedule C. So like if you were.
Schedule C.
Yeah,
okay,
Schedule C.
Okay.
Yep.
Okay. Mm-hmm. All right. So,
Hey,
okay.
Can I just add one thing?
Yeah.
I'll get a lot of calls over the years, probably, maybe a couple times a year now. And I think there's a misperception out there that a lot of people seem to think that you have to form an entity in order to get business deductions. So like, I'll get a call saying, well, I want to form an LLC so I can deduct this, this, and this. If you've got a business, every one of these entities has the same, from sole proprietor to C-Corp. They all have the same business. They all have the same deductibility as far as business expenses go. The only exception being a C corporation can deduct benefits paid to owners, whereas the other entities cannot. That doesn't come up often, but it could in a situation where, let's say, someone has very high medical expenses in their family, and their income is too high to deduct them personally. If they have a business that they can set up as a C Corp, that could actually be beneficial, but it's a pretty rare circumstance.
All right. So something that we run into, of course, and Walter, well, both you guys, as you both work in exit planning at GRF, is owners who are within 5 years of exit. And what, for small business owners, which entity is going to best serve them from a tax perspective if they're going to be exiting within 5 years? Who wants to start talking about that piece?
I'm going to let Steve talk about when it might actually be best to be a C corporation with the scenario you've described.
Yeah, I mean, I guess the way I'd normally start my response is a very dissatisfying way, which is to say it depends on your situation. If you ever talk to a CPA, that's going to be their first response as well. It depends.
Or an attorney.
Or an attorney.
Or an exit planner.
No, if it's the attorney's going to say it depends, and then bat around a couple ideas for an hour, and then come up with a solution just so you can build a full hour.
Yeah, unlike you guys.
No, we would never do that.
We would never do that.
No.
Typically an LLC is probably going to be your easiest transition, but there are cases with C Corps. Under the right circumstances, you can hit what's called Section 1202, qualified small business stock. And there are rules. There are a lot of rules with it, most of which I don't have just off the top of my head. But the basic rule is that as long as the gain on the sale of the stock is under $10 million, that you would not have a capital gains tax on that sale of the stock. You have to hold the stock for, I think, 5 years. It has to be an active business. It can't be a passive business. I want to say it has to be real shareholders. It can't be corporations or partnerships, anything like that. There's 4 or 5 different specific rules that you have to qualify into. But bottom line is, if you are the right business for qualified small business stock, it can be a huge tax savings event. If you're building something with the purpose of selling it.
Yeah, and a qualified
Yeah,
business.
we had a client come to us, I guess about 3 years ago, and it wasn't really a product per se. It was more like a intellectual property type thing that they were developing. And the plan was, they'd probably lose money every year. If they did have a profit, they'd plow it right back into the C-Corp or right into the business. And their goal was to go public within like 3 years. So that situation was perfect for a C-Corp, because what they were really counting on was an exit and a big capital gain. So, we had to talk to them about, like Steve mentioned, you need a 5-year hold to get the $10 million exclusion, which wasn't going to be a problem in this case. It's been almost 5 years now, and they still haven't been able to sell it. So, that'll work out fine. But that was the situation where they weren't going to take money out. So we didn't really care about the rules there. It was really, the main goal there was to lock in a tax-free sale when they sold the company. So that was the perfect C-Corp situation. A lot of businesses, when they start up, they may anticipate losing money early on. So if you make it a flow-through entity, those losses will flow through to the personal return and offset other income. So that can be very helpful. And like Steve mentioned, if you start off as an LLC, you can flow those losses through. And then once you become very profitable, you make the election to become an S-Corp, and you can start saving on some payroll taxes. So generally speaking, you're going to start as an LLC, maybe transition to an S-Corp at some point, unless the C-Corp makes sense. The one exception to all that is if you're just buying a rental property, you don't want a piece of property in an S or a C-Corp. That's either going to be a sole proprietor type entity, or it's going to be an LLC if you're looking for some liability protection. One other thing to be aware of, sometimes people don't think about it, but they just husband and wife decide they want to form an LLC. They just think it's nice that they each own 50%. Well, now they formed a multi-member LLC, and they're going to have a separate tax return every year. So you have to be aware of this stuff as you make your decision. So it definitely helps to either contact your CPA or an attorney.
Yeah, and you'll have situations that are not tax situations where it would make sense for a husband and wife to own an LLC together. Some jurisdictions, they have a woman-owned business has more favorable treatments in the county or in the state, which would be outside of a tax reason to do it. But there are good reasons to do it. But you see that a lot. Oh, we just decided we'd start an LLC 50-50. And you're just like, oh gosh, now we got to do a second tax filing. And so you're asking for all these questions. Well, why are you asking me all these questions? Well, now you have to file a partnership return. And then that's going to flow on your tax. It's like all of the headache and hassle, costs $2,000 or something to prepare that partnership return. And, it could have just been avoided if they hadn't set it up that way. So, Walter,
Walter, as you know, most of the businesses that we work with are pass-throughs, LLCs or sub-S's, with the occasional C-Corp. But your comments about Section 1202 a few minutes ago, Stephen, it just prompts me to want to learn more about it and increase my knowledge in that space. Is there enough material there for us to do a podcast on that topic at some point?
Yeah, I would think definitely.
Probably. We might be able, you might want to couple it. I think a good podcast would be tax advantaged ways to sell your business. Because there's the qualified business stock, which is the big one. But there are some other things you can do, like roll the proceeds into an opportunity zone, things like that. So maybe we cover the different strategies out there.
Yeah, that's good. Let's do that. Yeah. Okay. One other thing real quick, Stephen, if you want to do a guest blog for NSLP blog on section 1202, I'd be grateful, and I'll put it up there. Okay. So with the new administration around the corner, would you guys foresee any potential changes? I think you probably would. And any of the advice or any of the thinking that you've communicated to this point around, the right entities for any one of the phases, launch, grow, or sell?
I think there's a couple things. So when Trump became president, we had the Tax Cut and Jobs Act, that new tax law, and that really did a couple things that were pretty dramatic for businesses. One was it cut the C-Corp rate from a maximum of 35% down to a flat rate of 21%. So the whole idea of double taxation kind of lost a little bit of the fear of that, because now you're looking at a 21% rate versus a 35. So that was a big deal. President-elect Biden has said that he wants the corporate tax rate to go back up to the maximum. So that's one thing to keep in mind. That's going to make C-Corps less attractive. The other thing that was included in the 2017 tax law was that if you were a flow-through business or a sole proprietor, depending on the type of business you had, you potentially qualified for a qualified business income deduction of 20% of your profit. So in essence, if you were an S-Corp or an LLC or a sole proprietor, and you weren't like a doctor or a CPA or some other service businesses, you only had to pay tax on 80% of your profit. So that was another big deal for small businesses. That has not been specifically addressed by the incoming Biden administration, but that's something that could go away. But I think at the end of the day, our advice, if you're starting a business, is still going to be probably start out as an LLC and then change it if you need to down the road. I don't think, even though taxes are going up, I don't think the landscape of what's the best entity has changed dramatically. The one exception of that is that with the qualified business deduction, LLCs are a little better positioned than S-Corps. And I won't go into all the reasons for that because it gets very complicated. But we did have some S-Corps that transitioned to LLCs when the new tax law came into effect it actually took effect in 2018. And a lot of the businesses starting up now were structuring as LLCs, even if maybe an S-Corp could make sense in some ways because of this 20% deduction.
Yeah, I think the one thing I'd add to that is you saw the stock market do really well right after election night. And I think the reason for that was business likes divided government, because it normally means there's not going to be wholesale changes. And so I would say we kind of have to watch these Georgia runoff elections. What is it, January 3rd or January 6th? If you're looking to start a new business, you may just kind of want to wait and see what happens there, because that could affect your decision on what kind of entity you set up. If it's split, or if the Republicans win both, then you're going to have divided government. If the Democrats win both, it's going to be Democrat held House, Senate, and presidency. So it makes it more likely that some of the Biden tax plan changes could be implemented.
All right, excellent. Okay, guys, great content. Any final thoughts here as we wrap up? Anything you guys want to promote?
I guess a couple things. One thing I would just go back and say that, this, like you started the podcast, Pat, this is a really important decision. Fortunately, if you start off as a sole proprietor or an LLC, you're still in a situation where you can change that without tax problems at any point. If you start off as a C-Corp or an S-Corp, you could have some problems if you decide that's not the right type of entity. So just, once again, I think this is a truth pretty much for every topic we cover in our podcasts. You need to plan ahead, and you need to include the proper professionals when you're making these decisions. That's kind of my takeaway. As far as promotion, I would just encourage you, like you're going to at the end of this anyway, Pat, just to visit the website, see what resources are available to business owners. Other than that, nothing specific.
Okay, Steve, hey, if someone was impressed with everything that you had to say about 1202 and everything else you had to say, and they wanted to contact you, how could they do that?
Yeah, I mean, the best way is going to be by email. My email address is sboisvert@grfcpa.com. You can also call the office, and the receptionist will put you through. But to tag team on what Walter was saying about promoting, this is your last chance to do wholesale tax planning for 2020. As soon as 12/31 ends, we get into the new year, your options are pretty limited. There's still things you can do with retirement plans and HSAs and all that good stuff. But, if you want to do some real tax planning, the best time to do it, the full book is open in December. And as soon as we hit January, then that book starts to close a little bit. So if you're interested in tax planning, this is the time to do it.
All right, great. Thank you. And folks, if you want help maximizing the value of your business or planning for your eventual exit, you can reach Walter at 301-951-9090, and you can reach me at 301-859-0860. You can also access resources at exitreadiness.com, grfcpa.com, and nslp.com. Thank you again for listening. And if you have benefited from listening, please consider sharing the podcast on social media. We'd be very grateful for that. Until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.